What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends impacting investment. I'm your host, Nicholas Fawcett, Economist in the BlackRock Investment Institute, and this week, I'll be discussing last week's central bank decisions to tighten policy. The Bank of Japan surprised markets last week after it tweaked its yield curve control policy again, joining a tightening wave across developed markets. Both the US Federal Reserve and the European Central Bank also hiked last week, and we see them all holding policy tight and see rising bond yields in Japan pulling global yields higher. The Bank of Japan, or BOJ, took another step last week to wind down stimulus by loosening its policy of capping 10-year government bond yields. The shift saw Japanese 10-year yields rise to a 9-year high, and most global yields followed suit. This gravitational pull from Japan to interconnected developed market bond yields matters for markets, and it's gone relatively smoothly for now. The BOJ's move to relax its yield curve control is an important development. It's gradually joining the global policy tightening campaign, in this case, letting long-term government bond yields rise. The Fed also tightened policy last week as expected and indicated further hikes may lie ahead. The Fed knows that it needs economic weakness to bring inflation down, but it's not yet convinced that inflation's on track to hit its 2% target. Last week's reported drop in wage and price inflation in the US was clearly good news, but we still see risks as inflation remains on a roller coaster. Coupled with US activity data last week that were also stronger than expected, we see the Fed holding policy tight for longer than markets currently expect. Like the Fed, the ECB also tightened last week and believes that some economic weakness is needed to bring inflation back down to its 2% target. But it thinks that damage is unfolding now and struck a less hawkish tone than at past meetings. The ECB may have hiked for the last time, but it'll still hold policy tight even as further weakness materializes, given its determination to bring inflation down at all costs, in our view. Here's our market take. We see rising bond yields resulting from central bank tightening, and we're tactically underweight long-term bonds overall, but we do see regional opportunities. We tactically prefer European bonds to US peers as market pricing better reflects rates staying higher for longer, and we're underweight Japanese bonds on the risk of a further rise in yields. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com/thebid.